everybody, and welcome to the Dash Trader Newsroom. This particular session is on the market correction or the beginning of a new bear market. My name is Michael DeJoyer, and I am the Director of Educational Services and a licensed professional here at Dash Trader. I'm joined by my co-host, Jill Molandrino, Global Markets Reporter at Nasdaq. Jill, how are you?
Good, doing well. Thanks for having me back.
Wow, I can't say that we haven't been talking about the right things these days. I mean, you and I have been talking about inflation not being so transitory for over a year before they took the transitory word and repurposed it. Needless to say, the CPI number came in hot today, and inflation was not unexpectedly, at least for us, higher than expected. Last month, it was the highest level in 40 years. What does that mean for the markets?
Yeah, that was the highest reading that we got since 1982. It seems the data is catching up with what we are experiencing in real time when it comes to prices at the pump and food. I mean, the cost of meat is just insane lately, not even just at the supermarket, but you're seeing translate into restaurant prices as well. And if they're trying to get the services sector to pick back up again, you know, passing those consumers down, passing those costs down to the consumer is going to hurt the service sector as well. So it really is a perfect storm that really is impacting what we're seeing with the inflation numbers. And it's interesting, Mike, because I felt like last week and the week before, markets sort of seemed to get in a rhythm again, and we weren't seeing these fluctuations 1 to 2% to the up or downside. It seems as if markets kind of got it. Okay, we know we're getting 25 basis points in March after today's reading. I think the expectation now is around 50 basis points. Right. But I think that, what is it, 55 to 60% on the Fed fund futures is where it's at right now for that. So, and that's what really spooked the markets today, because we get it, we're getting a rate hike, but I think when the inflation number came in like that, it just kind of, threw the market for a loop, if you will. Not only that, but we're kind of, we came out of the real thick of earnings season, so now we're kind of in this vacuum. I know there's a number of big retailers and some healthcare companies to report, but we're kind of entering that vacuum season where this is the only thing that we're focusing on too.
Yeah, no doubt. I mean, I think that many of us professionals and people who follow the markets closely, we were expecting 50 basis points in March. But I think that after the CPI number, everybody else now is expecting 50 basis points, because, I mean, this was a very, very hot, I think it was 7.5%, inflation, projected inflation for the year, which was very, very, very high. Like I said, I kind of expected a high number, but needless to say, I think that the reality is setting in for the markets. On that note, we don't talk about bonds too often, but the yield on the 10-year rate topped 2%. This is the first time since 2019. Usually a rise in yields, okay, on the 10-year usually has very negative implications. Now, I was writing, when I wrote this was this morning, and the market really snapped back well. And of course, we've since seen the market roll over once again. So what stocks are the most sensitive to higher yields on the 10-year?
Well, of course, the banking sector is going to do well as rates move higher. It affects their net interest rate, their net interest margins. So you have that sector you need to look at. I think the commodity space you also need to take a look at. Energy space you need to take a look at. I had the head of research. Why can't I think of her name? Her name is Stacy Morris, out of Alarian Indexes. She was on with us this afternoon, and her expertise is in the midstream and MLP space. And she explained to us that the midstream space is kind of the infrastructure to make the energy space happen. And that is why they typically do well in raising interest rate environments and inflationary environments, because they already have that recurring revenue within that space to provide the infrastructure for the up and downstream companies. So they tend to be a little bit more insulated with that. I also think other areas that are going to do well, which goes across all sectors, are those healthy dividend paying stocks. I think because of some of the volatility that we're seeing in the fixed income space, sort of the unknowns with what interest rates are going to look like, companies that are solid companies that pay a solid dividend are also going to be attractive for investors as well.
Yeah, no doubt. So high dividend yielding stocks, high dividend paying stocks, some of the former dogs that really didn't participate in this tech rally, potentially banks, these are all companies that I would agree usually do well in a rising interest rate environment. I think that the other thing you got to, just look at is what companies don't do well. And that's really anything on the Russell 2000, the IWM, that's small to medium sized tech companies that rely heavily on loans, right?
Right, and that's part of what the issue is that the system was so flush with liquidity, and they were able to, whether it's buying back stock or reinvesting into the business, they were leveraging debt on such low interest rates. Part of the problem is that the piper is coming around now. We've got to pay the piper.
Yeah.
Many of these companies, whether they have been listed or we saw, I don't know, whatever, 700 companies brought to market this year, the majority of them via SPAC. Well, many of these are unprofitable. Many of them have revenue streams that are certainly not indicative of paying 80 to 90 to 100 times for these particular stocks. There was just so much momentum and so much good storytelling, if you will, in the marketplace, that the valuations far exceeded what they truly can execute on. And the music does stop at some point. Maybe it took a little bit longer than people had expected, but that's where we are right now.
Yeah, without a doubt, without a doubt. And I think that actually plays into the last news item, which was, Twitter had bad earnings and they announced a stock buyback, which really put a kind of a plug in their bad earnings results in terms of their stock performance today. But that tells me that Twitter has nothing better to do with its money than to buy back its own stock. That pretty much is how I read it, is that, a lot of these companies have cash on their books. And if they do, where would they put that money, and where could they put that money to good use? And it seems like a lot, at least in the last 2 years, we've seen most of these tech companies just reinvesting in their own company, buying back their own stock, reducing their float. And that really has helped kind of drive up this parabolic move in the markets. And there's a time when, you can only get so parabolic before you come back to earth,
Yeah, I think what the challenge is with Twitter, and you're right there, Mike, with cash on the balance sheet, in fact, that you're able to borrow so cheaply to buy back your stock, that's one thing as well. From a user experience perspective, folks like you and I that have integrated Twitter into our strategy, people who are dependent on news flow and being able to figure out with quick headlines, Twitter works well for us. I think the issue with Twitter, though, it hasn't evolved to a more consumer base, if you will, and maybe a more Gen Z base, if you will, and they're going to platforms like Snap. And we saw what happened with Snap, right? They're doing something right there. Yeah. They're going to TikTok. They're going to platforms that are perhaps embracing the virtual experience more, perhaps leading them into the metaverse, leading them into more immersive experiences. And Twitter doesn't offer that. And I think when the music stops, and with the exception of people like you or I who follow the news so closely, that you're kind of rebuilding your user base. And that's what's happening with Facebook. So it's going to be, it doesn't feel like Twitter is innovating in ways that a Snap or a TikTok is. They're kind of band-aiding here or there. And perhaps that could be why it's a little bit reflective in results.
Yeah, no, without a doubt, I don't really know of people who are professionally, other than people who are professionally orientated, who are stock traders, who just follow the news, or they're a celebrity. Those are the people that are using Twitter. And I really don't know what's next for Twitter. Like, Facebook and the metaverse, that's a huge investment, a huge financial investment for Facebook to kind of create the metaverse, which is what dragged down Facebook, because Facebook is exactly sort of like Twitter. It's these first generation social media companies that had no competition for a long period of time. Now Facebook, I think that was Mark Zuckerberg directly said, he directly blamed TikTok. It was like, oh, TikTok and Snap are taking our market share. That's why we haven't grown in users.
Right. And the thing is, he did not invent the metaverse. It does in fact exist, and it has been leveraged. Think about something like the Super Bowl. this
Yeah.
weekend, and what's going to happen with streaming and the immersive interactive experience. That could possibly be the coolest event that you see
Yeah.
all year round because of how they're leveraging this technology. So I am in agreement with you there. They're
Yeah.
kind of stuck with first generation and need to evolve.
Yeah, absolutely. So very, very good points there. Well, I'm going to jump to the charts. I thank you so much. We have one more slide, actually. I didn't.
Okay.
No, we got it actually. So basically, that's what is your general sense though from earnings season this year? I mean, what was your overall feel?
Yeah, you know what? I thought earnings season was more interesting than it has been in some time, particularly as we look over the past couple of years with companies getting a pass with COVID and with the way valuations were and the amount of liquidity that was in the system and the buy the dip mentality. But because we're not buying the dip right now, I think earnings season really meant more than it has in a very long time. And it certainly was a tale of the haves and the have-nots. I mean, just look what happened in, the top 10 Nasdaq 100 companies. When you look at a Facebook versus a Google, a Microsoft, and Amazon, where typically they move in tandem a little bit, but it feels like you've got to have a good quarter, you've got to have solid guidance, and you've got to have a story that will allow you to play with rates and inflation. So I think it's more interesting than it has been at some time.
I would totally agree. I think that this has been one of the best and most roller coaster / volatile and interesting earnings seasons that I've seen in a long time. And it wasn't just kind of like we beat earnings as usual. I think though, to a certain degree, kind of the valuations just got absolutely astronomical and they needed to come back to earth. And in a lot of ways that this should have been done a while back, but in the markets, we say woulda, coulda, shoulda, didn't. The markets got overheated. The entire economy pretty much got overheated and the markets got overheated from all the stimulus. And now we're just seeing the come down from that kind of stimulus overload. And you see that in inflation, and inflation only responds to one thing historically, which is rising interest rates. And usually the Fed is a little late to the punch when it starts its rising regimen, or at least it's been so for the last 20 years that I've been trading. But on that note, Jill, as always, it's been absolutely great. We're going to jump to the charts and show off some of the features of our Dash Trader. Have a wonderful weekend, Jill.
All right, thanks so much. Take care, everyone.
All right, see you in 2 weeks. All right, let me jump to my charts. All right, as I'm jumping to my charts, I'm noticing that we had a little bit of a breakdown in the markets here as I speak. This is I have running on my Dash Trader right in front of me. I have the QQQ here, and we are breaking down hard. This is the 15-minute chart on the QQQ. And if I bring up the daily chart on this, I'm just going to zoom this back. I mean, this is a very, very bearish, what we call a shooting star, but it's a shooting star after a gap down that snapped back, put in a double top, and then led to a drop. This is about as bearish as they come in terms of a bear flag. It's in the context of a bear flag formation. And if I put on the SPY, it kind of looks the same way. It has the same setup, bear flag, move down, etc. I'm just going to load up my momentum indicators. Here's my momentum indicators. So my momentum indicators say that we are deeply oversold and getting more oversold. If I put this on the daily chart, we were overbought, and obviously we're overbought. We're moving down. The momentum indicators are very, very negative. Probably we're going to see a turn down in the MACD, which is a lagging indicator. But from a perspective of the CCI, as you can see here, the CCI has a top, a double top, and a drop. I mean, this is about as big of a sell setup as you can possibly get going into the CPI. We got the DIA also indicating very, very bearish. We got stocks like Twitter, TWTR. Twitter also looking like a bear flag, but giving up whatever gains it got from its stock buyback announcement. AF, let's just see something here. AFRM had a bit of news today in that they accidentally released their earnings early and they got crushed. Really, really big move in AFRM, which is a firm. Another one is, let's just take a look at SLV. SLV had a big day today, but it's certainly turning back and pulling back a little bit. GLD, okay, has a high and then a lower, has a oversold. So gold is holding up fairly well, but that usually does as an inverse to the dollar. GBTC. We have Bitcoin has made a nice bounce back up, but it looks like we've put in a reversal bar on Bitcoin as well. So everything has pretty much gotten into sell-off mode after this very, very hot CPI number. Last but not least, I mean, we could look at some old economy stuff like US Steel's holding up well. Trying to think of something else that came out with earnings recently. AMZN. Oh, we'll take a look at Facebook. Amazon holding up better than some of the other big tech companies. And of course, we have Facebook, which, really got crushed. I mean, you can just see the big, huge gap down here on Facebook, but deeply oversold, bounced a little bit, but it certainly does not look like a healthy stock chart. I mean, basically, the entire market was being held up by all these tech giants. And now that the tech giants have started to crumble on this inflation news and interest rate rising news, you can see this in the IWM. IWM looking very bearish as well. So we got bear flags across the board, possibly the start of a new bear market. We are down about 20% if we go to the lows. Potentially, we could even go and take out and make out new lows, which would bring us down to about 30%. But either way, that is the charts for today. Just going to go back to wrap up our presentation. And here we are, the competition announcement. The dates have been announced for the DAS, and DAS is teaming up with Nasdaq for our next trading competition. Registration and boot camps are February 28th to April 3rd. Save $50 during early market registration. February 28th to market 7th. Competition runs 19 trading days in April 4th to April 29th. Prizes include up to 6-month access to the Dash Trader Pro platform, winner's name displayed on the Nasdaq market site, tower in Times Square. Visit onebesttrader.com to learn more. To stay up to date with all of our updates and all things Dash, sign up to our monthly newsletter emails at www.dashtrader.com. Simply fill out the form at the bottom of the page. Subscribe to our YouTube channel, Dash Trader TV, and get all your Dash Newsroom reminders. I have to say, we have really been spot on in kind of pointing out the most important elements to watch out for every 2 weeks. And our analysis in our newsletter has really cautioned traders to not just blindly buy the dip and to stay cautious as market valuations were really in danger zone. So certainly follow us on all of our social media links at LinkedIn, Twitter, Facebook, and Instagram. Have a great weekend, everybody, and certainly look forward to seeing you soon. Trade well.